Investing in the stock market used to be something that only rich people did. However, in recent years, it's become much more accessible to the average person and is easier than ever to do. But what exactly is the stock market, and how do I go about investing in it? And isn't investing super risky? How likely is it that I'll lose money? This video will discuss these questions, and we'll also talk about why it's such a good idea to invest in the stock market and why you should start as early in life as possible. Hi everyone, welcome back to the channel. My name's George, and I've been invested in the stock market for around 6 years now. But before I learned about investing, I always thought that it was only something that rich people did, as it seemed complicated and hard to do, and was only possible if you were rich enough to employ someone to do it for you. And I also used to think that it was too risky. I hated the idea that I could lose any amount of my hard-earned cash. But my mind was changed when I actually learned about the stock market and how it worked, and how to invest in it, and why investing was such a good thing to do. In this video, I'll try to explain the things that changed my mind about investing, and I'll also explain the best and easiest ways to invest in the stock market in 2025. So before we get into how to invest in the stock market and why it's such a good idea to do so, I think it's worth taking a step back for a minute to really think about what the stock market actually is, so that you get a good understanding of where your money's actually going. So to really go back to basics, a stock is simply a share in a company. Let's take Apple for example. If you were to go out and buy one share in Apple, this would cost you around $200 at the moment. Then you become a shareholder in Apple. And this essentially means that you now own a very small part of Apple. Or more specifically, you become entitled to a share of Apple's profits, both now and into the future. And you'd be able to benefit from this investment in two main ways. Firstly, Apple might choose to pay out some dividends to its shareholders. Essentially what this means is Apple will take some of their profits and pay it out directly to anyone that owns shares in Apple. The more shares you own, the more dividends you'll receive. Or secondly, the share price of Apple might go up. And this could happen for a number of different reasons. But essentially what this would mean is that your share is now worth more than you bought it for. Or it could be a combination of the two. You could be receiving dividends on your share, and the share price might be going up. In which case, great, looks like you made a good investment. So that's what we mean by investing in a stock. You might hear the words stocks and shares used interchangeably, but essentially they mean the same thing. So what do we mean by the stock market? Well, like any other market, it's a place where buyers and sellers come together to exchange goods. In this case, the goods will be the stocks in various different companies. So when we say invest in the stock market, we essentially just mean buying lots of different stocks from lots of different companies as investments. So you might be thinking, well, which stocks? Aren't there literally thousands of different stocks that you can buy from companies around the world? How the hell are you supposed to choose which ones to invest in? Well, that's a very good question, and there are a couple of different answers. Firstly, you could try and do it the hard way, which is to take it upon yourself to do some research and complicated financial analysis to try and work out which are the best companies to invest in. Or you could do it the easy way. You could simply take a list of the largest companies in the world, throw them into a basket and invest in them. So what I've just described here is what's known as active and passive investing. Active in that you're actively choosing which stocks to invest in based on your own research, or passive as you're passively accepting which stocks to invest in based on which ones are the largest. So it might sound like passive investing would be kind of a waste of time. Surely the people that put the effort in to do their own research are going to perform better, as in their investments are going to make more money over time. Well, in many cases, this isn't actually true. There have been many studies and research papers done over the years, which have shown that passive investors often outperform active investors, as in passive investors make more money from their investments than the people that spend ages doing their own research on which stocks to invest in. And this is just because the largest stocks tend to perform very well. So what I take from this is that you don't need to worry about choosing which stocks to invest in. All you need to do is invest in a wide range of large companies from around the world. And we'll talk about exactly how to do this in a minute. But first I want to explain why it's such a good idea to be invested in the stock market in the first place. Now, stock market investing, especially passive stock market investing, is by no means a get-rich-quick scheme. You need to have a very long-term time horizon, as in you need to be prepared to keep your money invested for 10, 20 or even 30 years. And this is because of two main reasons. Firstly, the stock market over the short to medium term is pretty unpredictable and has lots of ups and downs. So if you were to say, okay, I've got some savings that I want to use for a house deposit in 2 or 3 years' time, then this probably wouldn't be a good idea to invest these savings in the stock market today, as 2 to 3 years isn't enough time to ride out the ups and downs in the stock market. And the chance that you could end up with a lower amount than you started with is reasonably high. However, let's say that you're 25 years old and you've got plans to retire at a reasonably young age, say 50 years old. This would be an ideal scenario to invest in the stock market, as you've got plenty of time before you're going to be using your investments, as there's 25 years for your investments to grow and for you to ride out any bumps in the road. So to really highlight why this point is so important, let's take a look at this graph, which shows the performance of the American stock market over the last few decades. Let's say you invested some money 18 years ago, in April 2007, back when the S&P 500, which tracks the American stock market, was worth around 1,500 points. Now, 2 years later, you'd have seen your investments plummet, as the world was suffering through the global financial crisis, the worst economic and financial crisis since the 1930s, and your investments would now be down to around 850 points, or a 43% drop. But if you had a long-term time horizon and simply stayed in the market, then over the next 16 years, you'd have been invested in a period of substantial growth and one of the best stock markets that we've seen in many decades. And now your investments would be hovering around the 5,000 points mark, which would be a massive 233% increase. So hopefully this highlights the importance of having a long-term perspective when it comes to investing in the stock market, as no one knows what's around the corner in the short term, but over the long term we can be reasonably confident that the stock market will perform well for us, as this is what we've seen happen again and again over many, many years. And the second reason why it's important to have a long-term perspective is because of the immense power of compound interest. So for those unaware, compound interest, or simply compounding, is the process by which your returns or interest on an investment themselves start to generate returns and interest over time. And this keeps happening over and over and over again. And the effects of this are really quite remarkable as exponential growth kicks in. But this really only works if you're invested over a long period of time. Now, the best way to explain this is to look at some examples. On screen now, you will see an investment calculator, which is simply a calculator that looks at total investment returns over a period of time, given a starting amount and monthly contributions. So if we start with an initial investment of just $100 and we contribute $300 per month from our salary, and we assume an 8% stock market return over time, in 5 years' time, we'll be looking at a nice return of around $23,000, which isn't bad. And we can see that of this $23,000, 19% has come from interest and returns that our investments have generated. Now let's see what happens when we bump this time horizon from 5 years up to 20 years. We can see now that our investments are worth $177,000, with 59% of this amount coming from the returns that our investments have generated. As we can see, the compounding effect has begun to kick in. And now if we bump this up to 40 years, we can really see the compounding effects take hold, as our investment is now worth over $1 million, with the vast majority of this coming from the returns that we've generated over the years, rather than our initial sum or the monthly contributions that we've made. So hopefully these points prove just how important it is to have a long-term perspective when it comes to investing, as it allows the compounding effects to work its magic, and you'll have a much more chance to ride out the bumps in the road. And also how you don't need to worry about having to start with a large amount for it to be worthwhile. The example we used started with just $100 and $300 added each month. Even this resulted in a balance worth over $1 million at the end of 40 years. Okay, so hopefully now you're convinced that investing in the stock market is something that everyone should think about doing, no matter how small your initial investment. And now we'll talk about the best ways to actually do this in 2025. So the first step is to open a tax-advantaged investment account. And these will differ depending on which country you're in. But if you're in the UK, then this is known as a stocks and shares ISA, which is essentially just an account in which you can purchase investments. And any gains or interest you earn on these investments will be tax-free. In the UK, you're able to pay up to £20,000 per year into a stocks and shares ISA. In the modern day, you can open and manage one of these stocks and shares ISAs completely online, like you can with internet banking, for example. And there are a few providers to choose from. Names you might have heard of include Vanguard, Hargreaves Lansdown, or Trading 212. And I've actually made a whole video where I discuss the best stocks and shares ISA providers in detail, so feel free to give that video a watch if you're interested. But for simplicity here, we'll use the example of Trading 212, as it's the platform that I use, and personally I think it's one of the best on the market. So once you've opened a stocks and shares ISA, you can now start to purchase investments. Now, there are many different types of investments that you can purchase within an ISA, and different providers will let you purchase different types of investments. But if you're like me and you're just interested in putting some money in the stock market in general and being a passive investor, then you only really need one investment, and that's what's known as a global index fund. Now, to briefly explain, a global index fund is a type of investment fund, And you can think of an investment fund a little bit like a shopping basket full of lots of different stocks. So in the basket, you have hundreds or even thousands of different stocks from different companies. And what you can do is you can buy a share in the basket. So your share will be made up of lots of very small pieces in thousands of different stocks. And this is great as it allows you to be invested in the stock market without having to go out and manually purchase thousands of different stocks of different companies. You can just go to one place, the investment fund, and this is all done for you. So when we say a global index fund, basically what we mean is that the basket is made up of thousands of different stocks from companies around the world, as in it's a global investment fund. I've actually made a whole video where I discuss what global index funds are in much more detail. So if you're interested, feel free in having a look at that. But like we said, in a nutshell, they can be essentially thought of as a basket of different stocks from around the world. Okay, so how do I actually purchase shares in a global index fund? Well, if we use the example of Trading 212, what you want to do is open an account and get yourself set up with a Stocks and Shares ISA. And then you want to search for this index fund called the L&G Global Index, which is a global index fund with very low fees. And it's the index fund that I'm invested in personally. And that's basically it. Once you've purchased shares in a global index fund like this one, then you are invested in the stock market. Now, I appreciate this video is getting pretty lengthy, so I'll leave it there for now. But if you're after more detail about what index funds actually are and different types of index funds that you can buy, then I've got videos which go into much more detail, and I'll leave some links in the description. And if you've got any questions for me, then feel free to leave me a comment below. I'll be sure to get to them all. Thanks for watching.